The biggest risk in your mutual fund portfolio is that you haven't reviewed it in years. Most investors believe that once they've selected the good mutual funds, the hard work is done. You pick a few top rated funds, maybe diversify across large caps, mid caps, and debt, and then you sit back. Forget it. Let compounding do its magic. But the uncomfortable truth is that your portfolio isn't static. When markets rally, certain sectors outperform. Your portfolio may become unintentionally concentrated. A mid cap fund that has performed well could now be oversized. A once balanced allocation may now be tilted aggressively without you realizing it. Even worse, fund management teams change. A top performing fund today may lose its star manager tomorrow. As assets grow, strategies that once worked may struggle to generate meaningful alpha. Styles drift. And without regular oversight, your carefully constructed portfolio slowly disconnects from your financial goals. So the question is a mutual fund review needed? Yes, you need to review your portfolio, but no, you shouldn't be checking it every week. Research shows that how frequently you evaluate your investments affect your decision quality. This is known as myopic loss aversion, and it demonstrates something powerful. When investors check their portfolio frequently, they experience more mental losses. Short-term fluctuations can feel painful, and research shows that losses hurt more than gains feel. So when you look monthly, daily or weekly, you expose yourself to
Feeling
noise.
leads to
You see
terrible
red
choices.
numbers.
You
You
start
feel
reacting to
risk
all the
more
daily market
intensely
noise
and you
instead of
react
focusing on the
defensively.
long-term signal.
It increases the likelihood of switching funds prematurely. It fuels performance chasing and panic selling. Studies also show that investors who see performance more often tend to take less risk. Even when the underlying investment hasn't changed, checking frequently is not the same as reviewing intelligently. A proper portfolio review is structured, data driven, and spaced appropriately, typically quarterly or semi annually, not driven by short term emotional reactions. Discuss why short-term mutual fund performance is misleading. Mutual fund returns fluctuate because of market-wide risk factors, sector exposures, economic cycles, and random movements. So short-term performance is noisy. Research shows that over 6 months or even 1 year, most return differences reflect market conditions, not enduring managerial skills. And once you adjust for risk factors and expenses, very few funds exhibit persistent skills. In simple terms, a fund that outperformed in the last 6 months probably benefited from factor exposure. A fund that underperformed likely faced temporary headwinds, not incompetence. Reacting to these short term differences is often chasing luck, and survivorship bias, where poorly performing funds close or disappear from data and performance persistent, looks even weaker. This is why performance based switching after short term horizons often destroys long term wealth. So, what should a proper mutual fund review focus on? If frequent performance chasing is harmful, what should investors actually review? A proper mutual fund review should focus on structural integrity. Does the portfolio still reflect your risk profile? Aggressive investors may need higher equity exposure. Conservative investors may require debt heavy structures. Over time, proper and timely rebalancing restores this. Just looking at return is incomplete. You need to ask, is the fund delivering adequate returns for the risk taken? Is it generating alpha after adjusting for risk? Is volatility acceptable? How severe are drawdowns during this downturn? Does the fund beats its benchmark at least half the time across rolling periods? One lucky year means very little. Repeated discipline matters more. Are you overexposed to a single sector, theme, or market category? Market rallies can quietly concentrate your portfolio in a handful of holdings. High expense ratios silently erode long term returns. A review should expose hidden cost leaks. But how often should you review? because short term performance is noisy and frequent evaluation increases emotional bias. Reviews should be spaced intelligently. For most investors, quarterly reviews strike a healthy balance. Semi annual reviews may suffice for long term passive investors. Annual reviews can work if allocations are stable. The goal is to minimize exposure to noise while maximizing structural insight.
If you're looking to assess your mutual fund portfolio, we have just the right tool for you, and it's accessible in some quick and easy steps. Let me quickly share my screen to show you what I mean. Okay, the first thing you need to do is sign up to this page where you'll see an Analyze Now button. Once you click this button, you'll be redirected to this page where you'll see a Create a Review option. This is a free portfolio review tool that will help you track, identify, and make smart investment decisions. Let's click Create a Review. You'll then be redirected to a sign up page if you're not already logged in. You can use your Google account to sign up or just enter your email ID and get an OTP, and you can sign up via that as well. Now, as soon as you sign up, you will see the Import Mutual Funds Holdings option. You can either click Upload Manually, where you'll have to manually upload all your mutual fund options, or you can click Fetch Mutual Funds. And it'll ask you to enter your PAN number and mobile number. You can enter all of this, and all your mutual funds that you have already invested in will get automatically populated on the platform. But let's go to the upload manually option right now. If you choose to upload manually, you will see this option where you can upload your mutual funds one by one. You can enter the scheme, the number of units you've subscribed to, and the NAV. But if you have a CSV file in this format, you can also upload all your mutual funds together, so you wouldn't have to upload them one by one. You can click on Upload File, pick the CSV file that you want to add, and you'll see that all your mutual funds will get automatically populated. Click on Upload Transactions, and we'll see it get ready in a few seconds. It takes approximately 3 seconds to upload. You can also import more if you have more files. We have one more file, so we're going to upload one more. Let's see. There we go. And that is what our entire performance looks like. But let's go through everything one by one. On the top left corner, you'll see portfolio value, which is this. And on the right, you'll see invested amount. There's also an investment score on the extreme right, but we'll get to it in a moment. Let's scroll down to see what else we have. Now, these are the important bits, the diversification score and the health score. The diversification score helps you understand how many funds you have invested in and how good they are for your portfolio. We ideally suggest you to invest in 5 to 8 funds to not keep all your eggs in one basket. Now, beside the score is the health score, which helps you understand how effectively your portfolio is performing by combining risk-adjusted returns, benchmark alignment, and cost efficiency. This score takes into consideration your risk appetite and the kind of mutual funds you've invested in. And based on that, it gives you a score that determines the health of your mutual fund portfolio. Now let's go back to the top and talk about the investment score that we just skipped. Think of this as your portfolio's report card. A high score means you're investing efficiently, and a low score means that you might want to work on your portfolio a little bit more. This single score can give you an idea of how your portfolio is performing. Now, when you scroll down, you'll also see some other scores here. The first is the risk score, which gives you an idea of what your comfort zone is when it comes to taking risks when investing in mutual funds. The higher your risk score, the more comfortable you are in taking risks. Next is your risk appetite, which is based on your risk profile. This is automatically populated with the mutual funds you add for analysis, but you can also reassess your risk profile here and tweak this according to that. Risk appetite measures your comfort level with investment volatility and market fluctuations. Higher values indicate greater tolerance for risks. Then you have total funds, which is the number of total funds that you have in your mutual funds portfolio. Total AMCs, which refers to the asset management companies in your portfolio. and funds at risk. This section will help you identify which funds you need to take a closer look at. Based on all of these performance metrics, you'll then see some insights to improve the performance of your mutual fund portfolio. These suggestions will vary depending on the kind of mutual fund you invest in. Now, if you scroll further down, you'll see the strengths and weaknesses sections. This is a much more detailed breakdown of your overall portfolio. Our experts are available to break down your view and give you more detailed insights if needed. Now, if you scroll further down, you'll see an allocation section. You can take a look at asset classes and the subcategories here. These are also mentioned in a list down below. And finally, right at the bottom, you'll see a detailed chart that talks about the kinds of funds you've invested in, their asset class, subcategory, weight, expense ratio, and your returns.
Wright's mutual fund review tool provides a comprehensive data driven diagnostic for mutual fund portfolios, combining quantitative metrics with qualitative assessment to optimize investment health. By leveraging a multifaceted analytical framework, users can achieve a clear understanding of the portfolio's current standing and necessary improvements.